Hello and a good weekend to all. This is Larry Tentarelli with the weekly markets video for Blue Chip Daily Trend Report. Today is March 14th, 2020. We'll start with the disclaimer, which says that everything in the video on the website and on the Twitter feeds is for informational purposes only. And I wanted to get the weekly report out a day early. Obviously, we had some volatile and some newsworthy markets over the week. So I wanted to get the report done as soon as I could. So I've been working on it for most of the day. So I apologize for the after 4 o'clock start, but we still will have it out shortly. So we're going to go through some charts, but more than that, I'm going to spend a little more time on the outlook going forward. So we'll touch base on the weekly charts, and obviously, as everyone knows, it was a very volatile week and a big down week. So for the week, NASDAQ was down 8.17%, closed at 78.74. So there was a big reversal yesterday after 3:30, as everyone probably knows, and markets had sold off for most of the week, and then about 3:30 everything ramped up pretty sharply. We'll get into that in a minute, but right now at 78.74, so still holding in the middle of its weekly range. Gold backed off for the week 9% at 15.16, holding right over the rising 40-week moving average. We're going to talk about gold in a minute. The Dow was down 10% for the week, so we can see the Dow had a pretty big recovery yesterday, still down 10% for the week, underneath at the lower end of the weekly range. S&P 500, which we'll take a look at in a minute, this is the core market, closed at 27.11, so it made an intraday low Thursday at 24.78, and then the futures were down Thursday evening. When I looked, the futures were down, from what I remember, about 2% or so. And then it seems that and I was watching Bloomberg, it was probably about midnight. And about that time, the futures started to turn green. And then they were up at one point about 4 or 5%. And then the Australian market went from negative 8% to plus 4%. So that had a 12% swing. And then the Thailand market, which is a little bit smaller, but it went from negative 13 to plus 3. So there were all of a sudden some giant coordinated swings that came into the overnight markets. And I think that, and I don't know, but I think that obviously these banks, the central banks, are putting all kinds of money in the system, and they've got some other tools that they can use to ramp up the markets. So in either case, though, big reversal. Treasury yields closed the week at 95 basis points, up from the prior close at 70 basis points. U.S. dollar was strong, back over the 40-week moving average. Crude oil was very weak, down 23% at 31.73. We'll take a look at crude oil in a minute. Emerging markets down 10% for the week. Now, emerging markets had a nice recovery yesterday, but still overall down 10% for the week. GDX, now this one is that's a bad chart. So obviously down 35%. And I'm not even sure what happened here, other than maybe some type of a financial breakdown with the ETF. I'm not sure what it is. But what I do know, and this is something that I posted on the public Twitter this morning, is even if something goes down 35%, if I have a position, which I did not have a position here, but if I've got a position and I set a stop at, let's call it 10 to 12%. So if I have a position here and I set my stop here, as soon as it hits the stop, then the position automatically gets closed out. And if I set my risk at whether it's 0.5% or 1% of risk, then I know if I take this position and I've got, let's call it 1% of risk, then even if a position goes down, and as I said, I had no position here, but even if something goes down 35%, if somebody manages the stop and more importantly the position size, then someone who had a 1% risk position in here, even if it goes down 35%, their risk is cut to 1%. So that's important. Obviously to focus on stops and position sizing all the time. GLD was off for the week, down 9%, holding over the rising 40-week moving average. Then we'll go to page 2. Triple Q down 7.5, had a nice reversal coming out of Thursday's low Still off 7.5% for the week, but we'll see. Technology is in the strongest spot of the. Everything's been weak. Everything got sold, but technology, if we look at where it is, it's in its weekly base for right now. So TLT, we'll talk about this in a second, backed off 7.6% for the week. So there was a liquidity crunch, which is what it's being called, and everything sold off, and we're going to talk about that in a minute. Europe was down. Europe had a bad week, down 16%, and that still came up, it looks like, maybe about 8 or 10% from the low. But in either case, steady downdraft in Europe. So we'll take a look at the S&P, and then I want to get into the weekly report, because that's where I'm going to talk about what the technical overview is. So the S&P 2711 is where it closed yesterday. The low for the week was 2478, and I'm not going to try to put on here trend lines or anything, because I'm sure everyone who's been online has seen 100 different trend lines over the weekend. None of those are really, nothing is coming into play right now. So what I focus on in times like that is just raw price levels. So 3,000 was the key level that I wanted to see hold, as you know, from about a week or two ago, and that broke down. And then once 3,000 broke down, markets kind of went into a free fall. Now the next major level is 2,500. Now it broke underneath 2,500 for a little bit on Thursday, but 2,500 is a key. Often what happens is these round numbers, 3,000, 2,500, 2250, 2000, 3500, round numbers tend to be important levels in the market. So 2500 is where the early 2018 lows were 2553. Now the December low was 2346. Now I'm not going to sit here and try to say that this should hold or that should hold or it could come down here. I'm not going to do any of that, because I don't predict markets. But what I do is I look at what's actually happening. So 2,500 for now is what I'm going to treat as the tradable low. And all that means is that if markets pull back here, and markets are very, very volatile. So if markets pull back, I want to see how 2,500, if they bring it back down to 2,500, I want to see if that holds, if it gets tested, if the prices break down. So that's just the key level that I'm looking for. It's not a target. It's not a downside target. It's just a level that if prices come down there, I want to see. In 2,500, they tested it for a little bit on Thursday, and then the Treasury came out with their liquidity, and the market bounced up sharply, and then it held 2,500 for the most part. So we'll see if they come back down to 2,500 how it responds. So I want to go into the trend report, because I want to go through the key overview right now, and then we're going to take a look at a couple charts. So, and you can obviously read this at your leisure, but I'm going to go through some of the highlights that I wanted to touch base on. So the markets were weak. Now the equity weakness was being telegraphed, as we've spoken about over the past week or two, with weaker charts that were breaking down, and last week's close below the 200-day moving average in the S&P 500 was cautionary. Now, what didn't happen is the traditional risk-off assets, which are U.S. Treasuries, were also down on the week. And what I've included a link here to a Bloomberg article, and basically what it says is the markets went through a dislocation where the bigger institutions decided that they were just going to hold on to their cash. So instead of making liquid markets like they normally do, they decided that they wanted to hold on to their cash, and they weren't providing as much of a market. And what happened is there were some forced liquidations with some margin calls, and then there's just a lot of markets dried up. So what happened is basically everything went down last week. Treasuries, gold, other than the US dollar, pretty much everything went down. So the Bloomberg article goes into a little bit more detail there. So what we got right and what we got not right so far is the defensive positioning in equities that we've had starting on February 25th versus the S&P 500 has been on the correct side of avoiding this downtrend. Now, what isn't working right now is the move into the risk-off assets, treasuries, gold, and Japanese yen, which which were in uptrends first and foremost, but which traditionally in a stock market sell-off, these asset classes normally perform better, and they were in uptrends. They still are, but they normally perform better. So my anticipation from having these positions that were in uptrends were that if the markets broke down, which is what was being telegraphed technically, that these assets would benefit. As of right now, they have not benefited. So while the risk off call was correct, these assets have not benefited so far. So we'll see what happens going into this week. My cash balance is still very high at 78%. As you know, we've had no new single stock buys since late February, and the last ETF was March 2nd, which we got out of pretty quickly. And I continue to believe that high cash balances, reduced or no market activity, has been the best offset. So not trying to, as we've spoken about, not trying to find the bottom every single day. So now here's where we are now. And this is what I wanted to spend a few minutes on. So where we are right now is there's a couple items I'm going to look at. So number one, the price. So the S&P 500 is corrected. It corrected 26% in 16 trading sessions, which is the fastest correction of all time, of that steep of a magnitude from all-time highs. Now, what happens is there is one positive to this, and what the positive is that the markets function off risk and reward. So at 33.93, the market said that there was significantly more risk in the market, so it prices everything down. So the S&P came to 24.78 on Thursday. Now what happens at some point is the risk and the reward start to get into line. Now, I'm not saying that they're in line right now or that they're in line at 24.78, but obviously the market at 25 to 2,700 starts to offer better risk versus return than 3,400. So what the problem is now is the market is trying to figure out, based on all of the healthcare issues, all of the economic uncertainty, and based on all of the lifestyle uncertainty, where now people have to work from home and the kids aren't going to school, and everybody's day-to-day routine is being turned upside down. The markets are trying to figure out. So the market said at 3,400, the risk was too high. At 3,000, it was too high. So now the market's between 25 to 2,700. So if we come back here, so now the market, the risk was too high here, the risk was too high here. So now the market's trying to figure out, where is the price equivalent to the economic uncertainty and risk? And that's still to be seen. So the market may say that 2,500 is that level. It may say that 2,200 is the level. It may say 2,000 is the level. It may say it's there's no way to know. But this is what the market is trying to do, and the reason it's moving so fast is it's trying to discount at what point has the price come down enough that the unknown economic uncertainty and the future risk is priced into the price. And the market maybe has not figured that out yet. So that's why we see these gigantic moves, because there's just unknown news flow. Now the other issue, and something that has changed obviously, is central bank policy. And what's happened is the United States central banks and central banks all over the world, the ECB, Bank of Canada, Bank of Japan, People's Bank of China, they are all, I saw somebody on Bloomberg commented, I think it was yesterday, that the Federal Reserve brought an aircraft carrier to a knife fight. And what that means is that they are pulling out all the stops. So they committed, it's anywhere, I've read different reports, between 1.5 to an extra 5 trillion. So this is just from the Federal Reserve. So the ECB is adding money. All of these other central banks around the world are adding money. They've got ways to create fiscal stimulus. The interest rates, the Fed's going to meet on Wednesday. They're expected to cut by another full percentage point. So here's the thing. So these central banks, just like the market, as the market has come down at a record speed, I think the central banks, they're not sure how to react either. So what they're doing is they're going in with every tool they've got. And what happens is all this liquidity makes its way into the system. Now they need the liquidity because there's been a liquidity crunch because institutions don't want to give up their cash. But what we saw on Thursday night is the S&P 500, as I spoke about, the futures went from down 2% to plus 9% yesterday in the S&P. Australia at one point was down 8% and it closed up 4%. So these 11 and 12% swings only usually happen when there's an excess amount of liquidity and there's other tools that these central banks can use to put money into the market. So here's the thing. All this liquidity cannot necessarily stop the markets from going down. I've got a typo there. I'll get that fixed. But they can't stop the markets from going down. So if the markets are going to go down, they're going to go down. But what all the liquidity does is it does provide some type of an extra layer of buying and an extra layer of support. And also what it does is and I posted this on Twitter the other day, is if somebody's a large institutional short seller and they're looking to just press this market down, if they know that at any given time the Federal Reserve or the ECB or the Bank of Japan can come out and say we're going to put another $1 trillion into the system. We saw what happened yesterday at 3:30 when there was some what was perceived as good news with the press conference. The markets ramped up substantially. So anyone that was heavy short and that price action it looked a lot like short covering because a lot of the names that went up were the ones that were down the least. And it could be anything. I don't try to determine what it is. But I know that if I had a significant short position and then the market starts to ramp up, then the shorts they start to cover, especially going into the weekend. So what all of this money does is it adds an extra layer of volatility to the system, but it does help to put in some type of a stabilizer. Now, here's the thing. When we get to the other side of this healthcare issue, which we will at some point, and I'm not a healthcare expert, I'm just looking at what's happening in the world, and I'm going to be optimistic. But when we get to the other side, whenever that is, all this liquidity is going to be in the system, and they can't just pull it back right away. So they're not going to have a news conference and say, okay, the healthcare crisis is over and we're taking back the $5 trillion. That's not how it works. So usually excess liquidity normally leads to a big high or a big move up in risk assets. So the economic risk, I want to reiterate my view first and foremost, obviously, that I understand that this is a human and a healthcare issue. So when I talk about financial markets, I don't want it to sound like I'm downplaying the seriousness of it because I'm not. But what the markets are trying to price in, and here's the biggest issue right now, the markets are trying to price in what's the economic impact of basically countries being shut down, and they don't know. And it's an unprecedented issue. The volatility is extraordinarily high. And this is why I think that we continue to see 2,000 point swings in the Dow Jones and 5 or 6% swings in the markets every day, because the market, they just can't price in this news, and that's why the volatility is so high. So here's what I see as my plan going forward. So, and once again, keep in mind, and this is obviously not any type of advice or recommendations, because what we do is we provide general commentary. We don't provide any type of specific advice. And just because I share my views, I don't think that anybody else should do what I do. This is just for pure information. So the way that I look at it is I'm sitting on a lot of cash. So I can approach it one of two ways. I can either A, sit in all my cash, wait for more clarification, wait till all the bad news is out of the system. And I don't know how I'll determine when the bad news is out of the system. I can say that having traded since 1998, this is not a garden variety pullback. This feels much more like 2008 than it feels like 2018, just because of the rapid decline. So here's the thing. So if I decide I'm just going to sit here in cash and wait until all the news is out of the way and the market put in a low, what will happen is I don't try to call the low. And what's going to happen is when the bottom actually hits, most people won't believe that was the bottom. So what happened in 2009 and in 2018, 2011, when the low finally hit. So in 2018, the low was around 2346, and as the market started to go up 24, 25, 26, 2700, some people said, well, that's not the low, it's going to go lower. Some people said, well, there's always a retest, and then the next thing you know, the market's at 3000. So I don't try to call the low, and I have very little faith in most people's ability to spot the low in real time and know that that's the time to move all the money in. So that's not something that I look to do. Market timing all at once is a very difficult longer term strategy. So option two, what I can do and what I'm going to do is sitting on 78% in cash. What I'm going to start to do is I'm going to look to start to build smaller, longer term positions over the next week or two on a scale-in basis. So what that means, I'm close to 80% cash. So what this means is over the next week or two, I'm going to look to move in maybe 5 to 10% of my 80% in cash into smaller positions. So what that means is that if I normally size my risk at 4 to 5%, so if it's a $100,000 account and I want to buy Microsoft, my normal position size might be 4,000 to 5,000 in Microsoft. Well, what it will be in this type of a scenario is I'll start at 2.5%. So instead of putting 5,000 in Microsoft, I'll put 2,500 into Microsoft. If my normal stops are in the 12% range, then the stops are going to be in the 15 to 20% range, and my risk at 0.50 will be that or less. So and just a hypothetical, if I have a $100,000 account, I'm going to look to start a position in Microsoft with $2,500. If I have a stop that's somewhere in the 15 to 20% neighborhood, I want to be sure that my overall risk, so if I'm wrong, doesn't cost me more than $500. So I'm only going to focus on three names. So I'm looking at the XLK ETF, Apple, and or Microsoft. My total risk would be up to 1%. So what that means is that if I start to build a position in XLK or Apple or Microsoft, and I size my risk right, if I start to commit my money and the market goes down 5, 10, 15, 20%, the most that I have at risk is 1%. If these positions start to work and the market starts to give bottoming signals, I can always scale more in. If not, and the market's considered much lower, then my total risk is 1%, which is extremely small risk. So either of these strategies could work. If I decided just to sit in 100% cash, ride it out, and then wait till all the news is good and everything looks better, and then I think that the low is in the market, that's absolutely a strategy that I could choose. Or I could choose my scale-in strategy, which is what I'm going to do. Now, the next 10 or 20% move in the S&P would not surprise me whatsoever. So just because I have a plan to scale in a small percent of my capital doesn't mean that I think that the market has made a bottom or it can't go lower, because I know that the market can always go lower. So I'm not going to try to predict it. If the S&P were at 2,700 right now, if a week from now the S&P was at 2,400 or 3,000 or anywhere around there or higher or lower, none of that would surprise me, because right now we've got unprecedented volatility. We've got a record amount of stimulus. It's a very, very volatile market. So what I'm not going to do, I'm not going to try to make an all-in bottom call. I'm not going to just put all my money into the market right away. And I have very little faith in anyone's ability to call the exact lows. And it's not going to be easy. And as we found yesterday, some of these stocks went up from the prior day 10 to 15%. So it's not going to be easy. The volatility is not going to stay low. And I'm going to figure out, okay, that's the exact time to put all the money to work. So that's not what I'm going to do. I am going to look to put maybe 5 to 10% of my 80% to work over the next week or two in one or two ideas, smaller position, wider stop, and then see how it goes from there. So what I am going to focus on is technology. Apple and Microsoft are the two key names. Now, on any resolution or stock market recovery, and keep in mind, the low could be in or the low might not be in for 6 months to a year. We don't know. On any resolution or stock market recovery, most stocks will go up very quickly, and the low will usually happen before all the bad news is out of the way. It can get complicated, but if I scale in, so as I said, I have no idea if 2,478 or whatever it was, if that was the low, or if the low comes in 6 months and 20% lower. I don't know, but I'm going to focus on those two ideas. And then one other idea that showed up on my screen, and this is longer term, and keep in mind that everyone has a different time frame. So I'm going to continue to avoid energy, travel and tourism, crude oil, all of these that have gone down significantly. I think in crude oil, under $40, many of these mid-tier names could go away. And here's the key thing. The way that I approach markets, I don't try to determine if a certain stock is going to go up or not, which is a very fundamental. So I don't look at ExxonMobil and say, okay, do I think Exxon is going to go up or not? Because I don't have any, I don't know. But what I do is I have a process. And what my process is to find the strongest ideas in the technically best charts that I can find. So when I'm looking around at these energy names and these travel and tourism and crude oil, they could turn out to be the best winners. They could also get cut another 50%. Nobody knows. But I'm not saying that. So just because I'm going to avoid airlines and cruise lines doesn't mean that they can't go up, multiples on any recovery. It just means that they don't fit into my process. The only one that came up on the screen, as I said, so ExxonMobil has a current yield of 9%. It looks like they made $13 billion last year, and they've got very little debt. So this one did come up on the screen because what I also do run a screen of stocks that have gone down the most. So I look for stocks. I run a couple different screens. So in either case, Exxon is an interesting longer-term idea that's just on my radar screen. So in summary, risk versus reward has improved, obviously, with the S&P going down 26%, and central banks are at work. On the flip side, news flow is very volatile. We likely do have more bad news, unfortunately, before we have good news, and I don't try to predict the news flow. The economic impact cannot be determined at this time. There's a lot of volatility. I do continue to expect high volatility, 5%, even 10% up or down days in the market wouldn't surprise me whatsoever. And I am planning gradually over the next, I would say over the next few weeks, I could do a little bit this week if the prices come down enough and if volatility doesn't come down. But I would say over the next, if I had to guess, I'd say over the next week or two, I'll gradually look to put a little bit of money into either the XLK ETF or one of those Microsoft or Apple. Like I said, it'll be small position and wider stops and small risk. So I appreciate everyone's time, and I will get this posted shortly.